Hello, a very good evening to everybody who's tuning in on the live. It's Rob Stewart with you with the weekly live show. We're looking at the market data for the property market, looking to see what the headlines are, but delve deeper to understand what's really going on using objective analysis, not the FUD, fear, uncertainty, and doubt that the mainstream media puts out. Why do we do it? I run this show for property investors primarily, and welcome if you're new to the channel. If you are coming to the channel, please do subscribe and like. And by the way, as we're on the live, if you could please give me a thumbs up if you can hear me and see me and everything is working great, that'd be fantastic. Welcome back to regular viewers. This evening, we are going to be talking about something that I picked up on over the last week in the media, but often these stories start, which could be the indicators, the leading indicators of something that might change the course of the property market over the next 12 to 18 months. So I want to dive into that and look at actually what's going on with the data. Okay. If you are watching this on the replay, hello, I know it's not the evening. Please put in your comments on the live, on the replay, put in your comments as well. And I always try and come back and answer them as we go through. I always like to get a conversation going rather than just me sitting here lecturing. I'm always keen to find out what's going on the shop front with everybody else in their areas as well. Luckily, just before I went live, my iPad ran out of battery. That's always the issue with doing things live. So I do have a backup, which is screen sharing my computer. So let's make sure this all works correctly. What are we going to be looking at? Okay, I want to start by going through the state of the economy, right? GDP, what's happening to the economy? Are we going to go into recession? Are we not going to go into recession? How is this interlinked with the property market? For regular viewers, you know I talk a lot about this, how symbiotic the property market and our economy is. I'm going to be looking at unemployment. This is the big thing that has started creeping in to the media over the last week. Is unemployment on the up, and why does that matter? I'm also going to, at the end, just talk about a couple of other things. Is there a credit crunch coming? Some talk about lending tightening. Obviously, the mortgage market has been in turmoil over the last month or so. Is there a bit of a credit crunch coming? How's that going to affect the property market? And also, let's just talk about tomorrow, because we've got two pieces of major news coming out. One piece of big news that everybody's waiting for, and then the other is the UK HPI house price index. These are both coming out tomorrow. So CPI inflation print is coming out tomorrow, the latest monthly one, and the latest monthly UK house price index. So as it's the evening, a lot of people will be watching this on the replay tomorrow, which will be Wednesday. I'm going to let you know what my thoughts are for the UK HPI, which is that I think it's going to have a little tick up this month. And the reason I think that is because the UK HPI most closely mirrors, Halifax HPI most closely mirrors the UK HPI. And if you remember, the Halifax HPI had a little period of very slight upticks. So if I was a betting man, I'd say UK HPI would tick up a little bit because it's reflecting data from potentially 6-9 months ago. So kind of, that uptick after mini budget. Inflation, that's going to be a much more interesting thing, right? I haven't seen a lot of predictions this time because every time a prediction about inflation print goes on, it's wrong. So let's just keep an open mind, see what comes out tomorrow, because I think that is going to be a fairly good indicator of what's happening over the next 6 months or so. Oh, sorry, that's definitely the wrong button. Don't want to be pressing that. So before I jump into those things, I want to just have an overview of where we are in the market. So I always talk about the three main triggers that's going to lead to what I would say is a full-on catastrophic property market meltdown. And by the way, just for the record, I do not believe that is going to happen. I've said since I started this channel that I think it'll be longer and shallower rather than a big sort of, crash, whatever crash means. A lot of professionals class a crash as 10% in a year. I think we could get to that, but I don't think it's going to be a complete meltdown. But the three triggers, right, that will lead to this are 1, negative equity, 2, affordability, and 3, unemployment. And right now, the thing we've been talking about most is affordability for the last couple of months. Affordability, cost of living, interest rates going up. Here is a graph from the latest Rightmove HPI, which came out, I believe, end of last week. I like this graph because it shows the difference between actually renting and buying a house for first-time buyers in terms of affordability. And this is the average monthly amount spent on a first-time buy home. This is before you look at utilities, before you look at inflation. This is purely mortgage costs, right? You can see that it spiked up, it came down a little bit, and now that fall has arrested and is staying high because obviously the interest rates are going up. But we've talked long and hard about how affordability is the thing that's really driving the market at the moment. Last week, I talked about a affordability index report, if you like, from ASDA, which says for the average person, 77% of your income is spent on essentials and tax, and that's getting squeezed. So your disposable income, the amount of discretionary income to spend on stuff, right, is squeezing every single month at the moment. And then with the negative equity piece, negative equity is not really a driver of a housing market crash. It's really something that accelerates, almost lights the touch paper, if you like, for a housing market crash. And that when the housing market does come down, if you have a look at this graph, you can see this is the UK HPI. So you can see we've come down, not a huge amount, but that means there are some people in negative equity, but not enough to sort of really gain momentum here. If it carries on going down, more people get into negative equity. That compounds the issue. What I really want to talk about today is that third pillar, because, right, I'm just going to, this is so important. I'm just going to come off this for a moment. Every single economist, analyst, expert who's been talking about the housing market has said that the thing that is propping this market up right now is the tight labor market and strong wage growth. Okay, so we've seen strong wage growth. However, when it's inflation adjusted, it's actually been real-time loss. So that does not mean people have more money to spend on luxuries, consumables. We're getting poorer with that. So even though it's 6-7%, whatever it is, still below inflation. But there's been a very tight labor market. However, if that was to turn, that is effectively probably the final leg, or if you think of these three things as legs on a tripod supporting a table or something like that. We've had sort of two been buckling. One's been really buckling. Now more people are in negative equity, but it's still holding the thing up. If the third goes, right, that table is just going to come crashing down. So we need to keep a tight eye on this. And again, this is going to be glacial pace in terms of if this plays out, is it going to play out? How much is unemployment going to go up? But I want to start on this fan chart, which is actually from government. And this is the projections on unemployment for the next 3 years. What's that? 23. So that's this year to 26. Now, these are projections, right? I always talk about there is a quantum scale of probabilities. Anybody who talks to you in absolutes about anything has no idea what they're talking about, because we can never with certainty say what the absolute outcome will be. So we have to look at what's the range of probabilities, and we're going to have the strongest probability is going to be in the middle. And, as we come further out, that probability is going to be less. So if you look at this fan chart, sorry, I know I have to look down because I don't have my iPad with me. You can see the dark purple is indicating an expectation that unemployment will go up, but not by a huge amount. If you take sort of the middle of that, it's 4.5%, isn't it? Maybe just over 4.5%. But then there is a possibility that it could go either side of that, right? So what's that? Down 1.5% up to sort of 7%. And that's, it's going out 3 years into the future, or 2.5 years into the future. Now it's quite a long way. And nobody knows exactly what's going to be happening in the economy. But the expectation is unemployment will go up. And that completely makes sense, right? Because to tackle inflation, effectively, Bank of England and government are trying to break everything short and sharp to reset and get rid of this inflation. And if the wage market carries on being tight, and if wage growth carries on going up, which it has been, and we'll see what happens in the CPI printout tomorrow, right? Wage growth carries on going up. They're going to have to carry on putting the interest rates up to try and break this, right? The longer it goes on, the more they're going to have to go up, the more sort of, I would say, more catastrophic a breaking event will be. That's my personal view. I might be completely wrong about that. If we have, by the way, I'm just trying to navigate around the slides so I can try and see some comments as well. I will dip in. Put in your comments what you think, by the way. Put in your comments as we go through this. I will dip into the comments section. I apologise, my iPad has ran out of battery, so I can't see the slides and the comments at the same time. I'm going to have to flick a little bit. Right, anyway. I want to relate to this graph. That I really like this graph, so I think it demonstrates the point really well about how there is a range of outcomes or a range of possibilities out there. This is something I talked about last week, and it's a little bit outdated now, this piece of research, but it's by Lloyd's, and it's the house price prediction based on various circumstances from a, sort of really good, baseline, not so good, really catastrophic. And you can see here, we're in 2023, obviously, sort of baseline there, the upside scenario that Lloyd's put with the property market in 2023 is minus 2.7%, okay? The worst severe downside is minus 17.9%. What I'm going to do is that's a massive swing, by the way. It's a massive swing. But what it agrees that all scenarios, we're seeing a dip in the housing market. What for me is more interesting is actually looking at the assumptions that go into this, because what I want to start doing as this plays out is looking at people who are a lot more clever than me, right? Paid a lot more money than me to analyze this sort of stuff and look at these scenarios and then kind of assess where we're going in terms of real time to try and get an idea of where the future might take us, okay? To see where those trends are. So if we look, and by the way, I've got my glasses off, so I'm struggling to read this. But we can see that, right, in 2023, which is where we are, if we look at the base case, it's got base case interest rates at 4%, which we're already 1% above that. It's got unemployment rate at 4.9%. Now, we'll go into the figures for unemployment in a minute, right? We're nowhere near that, right? It's ticked up to 4%. So before everybody gets super crazy about, our unemployment's going up, everything's going to melt down, the base case Lloyd's prediction is unemployment at 4.9% in 2023. Now, I'm not saying we won't get there. We're still, just over halfway, but that's base case, right? If you look at their worst case scenario is, let me look, unemployment of 9.8%, right, with a GDP of minus 4.5? I'm sorry, my glasses are not on. I'm a human. Minus 4.5, right? We're 7 months into 2023. We are nowhere near that sort of scenario right now. But let's look at the trends. Let's look at where it takes us. Because if we start trending it out, right, we can start to understand with these models where it might take us over the next 12, 18 months. But right now, I would say, right, we're somewhere between upside case and base case scenario when you look at that table, right? So if you chart that through, and if I go back a slide, base case scenario minus 2.7% this year, and then next year, what's that, 7.2? I don't think we're going to see that, by the way, because I think this is all playing out much longer than anybody expected, and I think the base rate is going to go up, probably another 0.5%, 1%. Let's see what happens tomorrow. So it could be that these scenarios are playing out, but more slowly. So that's why we need to understand what's going on with the trends. Hopefully that makes sense, okay? So let's dive into the headlines that made me want to focus on unemployment this week. Saw this, so unemployment has ticked up to 4%, okay? 4% is not a lot, but we're going to go through how unemployment is actually measured in a bit. So we are in an uptick, and we've actually seen a few consecutive months of uptick, and we'll look at the trends in a sec. Wales, unemployment in Wales rises for third month in a row. This is the thing that really, I'm not actually, let me share the screen. I'm not sharing the correct screen for you. This is the problem of not having an iPad. This is the article that sort of really got my attention. The falling jobs advertisements ring a recession alarm this is from James Reed. Now, I always like to look at leading indicators and as far in the future as we can. So what's the first leading indicator? What's the furthest in the future leading indicator we can look at here? And something like advertising for vacancies is clearly going to be a leading indicator about what's going to be happening in the market, in the jobs market in the future. And when we look at this, there's been a sharp and a statistically significant drop in the amount of vacancies that are being advertised by businesses at the moment. If I can sort of give you some stats there, jobs listed with Reed Recruitment are down 24.4% in the 3 months to June from a year earlier, and are 26.6% lower than the same time in 2019 before the pandemic. So you're talking, roughly 25% lower, 3 month, quarter on quarter, and same point before the pandemic. That, I would say, is statistically significant about what is happening with businesses and their recruitment. So when we forward project and look at that, right, by the way, I'm a business owner as well. I have a scaffold company with about 25 employees. And for the last year and a half, we haven't been able to get labour. I have to be honest now, it's difficult to tell exactly what's going on because you can't just go anecdotally on my own business, right? But I know last year we could not find scaffolders for love nor money. This year, right now, we actually have scaffolders coming to us asking for work. Difficult to tell whether that's the jobs market or because we've done quite a large change, transformation sort of project about the culture in the business, which is making it more attractive. I'd like to think it's the latter, but it's probably going to be the first, that there's actually more people looking for work out there. And that's an interesting leading indicator, right? Where does that then go? More people looking for work, more people not in work, people can't afford stuff, people can't afford mortgages, start defaulting, right? Everything starts to compound and accelerate away. So I think that's interesting to keep our eyes on what's going on the jobs market. Right, I'm going to go to questions and see what questions got. What are you seeing, by the way? What's your thoughts on where we're going? Are you seeing any leading indicators? Do you think it's just a blip, just complete irrelevance? We'll look at some graphs in a second, by the way. But let's just look if we got any. Sorry there. I know some people saying you can't see the graphs. I know we've sorted that one out. They're saying, what indicators are we using to predict unemployment? It's a very good question. Look, I'm not a specialist on unemployment or employment. The indicators I'm looking at, I think that's one of them, is job vacancies, businesses advertising for jobs. You know, if the jobs market is loosening, businesses are not recruiting as much. I think that's probably the best leading indicator we can use until we actually see that unemployment stats, right? But we're going to need to understand what unemployment actually means, because of course, stats are stats and stats can be skewed. We can argue stats however we want. I know everybody does. So we're going to see what actually happens with those stats. Okay, right, let's get back to the slides. Apologies for that. Before I look at the unemployment, I want to look at the state of the economy. Because talking about stats getting skewed, everybody seems to be focused on this word recession. It's like, if we're in recession, it's bad. If we're not in recession, it's good. If we're in recession, it's going to be bad for the housing market. If we avoid recession, housing market's going to be great. You know, I put a slide up a few times about the symbiotic relationship between GDP and housing market and how it's circular, right? And housing market drops, people have less or consider they have less to spend, therefore they spend less, impacts the economy. Economy goes, perception-wise, economy's going down, we're in recession, we have to spend less, and it goes in a cycle. That's great, but what's the definition of a recession? The definition of a recession is 2 successive quarters of GDP drop, okay? Which means it's very easy to actually skew those figures and say we're not in a recession. So I think we are, at the moment, when you hear sort of the headlines, like we've technically avoided a recession. Here's a chart of our GDP. This is our economy, almost like, you know, the lifeline, the heartbeat of our economy, right? Does that look particularly healthy to you? That is a flat line. That is growth, COVID, V, flat line. And that is flatlining after the biggest financial stimulus package, the biggest amount of quantitative easing, right? And everybody being given loads of money to sit at home, and businesses being given loads of basically free money with very low interest rates over very favorable terms. And that is what's happened. Now, I'm not going to talk about it now, but if you compare our economy to something like the US economy, completely different graph, right? That is carrying on going up. This is not particularly healthy. Yes, it's not dropping quarter on quarter, but who cares, right? Let's have a look at this. I've actually had a bit of a nerdy afternoon because I wanted to really break this down and see where we are. This is the month by month figures of our GDP, right? And what is interesting, or what we need to understand on these figures, this is from the ONS. What we need to understand from these figures is 100 is the baseline and 100 is our GDP in 2019. So, for example, 100, if you look at October 22 there, 100.35 is 0.35% above the baseline, which is 2019, right? So pre-COVID, 0.35% above. So if we actually look at this, right, in May 22, we're 100.77, right? We're 0.77 percentiles in May 22 above baseline. And then that drops. But then if you look at it quarter on quarter, right, and January, February, March, April, so we're not actually in proper quarters here, how this is done. But if you then look at three month chunks, we don't get a single 3 month chunk where it's dropped quarter on quarter. So it goes down, it comes up again, it kind of goes down, it comes up again. So technically we're avoiding recession. If you look at where we are now, May 23, we're 100.36, right? We're 0.36% above baseline. So we are lower now in terms of our economy than we were in May 22. So if you just draw a straight line, right, it's down. Of course, it's wiggled around a little bit, or kind of meaning around not very much. But basically, we're barely any different to where we were at 2019. So that's where we are now, before all of these interest rate rises start filtering through. They talk 12 to 18 months for interest rate rises to filter through and start to have an effect. All the stuff we're seeing right now is going to come into effect next year, 2024, mid 24, end of 24, potentially even beginning of 25. Okay. So as a forward indicator, that for me is not looking particularly pretty. The other thing that I found interesting in this data is they put out GDP data on a monthly basis, and then they're still getting data in. So there's lag in some data. It comes in and they revise. This is the last GDP data report, which is May this year. They've got the revisions for January to April 23. And what stood out for me was the revisions in the construction sector. So there's three things they look at for GDP: services, production, and construction. Right? If you look at construction, there's quite heavy revisions down, which means for me that construction sector is being affected more than anything else. Actually, when you look through all the data, it's not a riveting read. When you look through all the data, let me just go back full screen. The production is down a little bit. Services are quite variable actually, but generally higher. And construction, which is the smallest part out of the three, is down the most. So I think it's interesting seeing that with everything in this country, construction is the thing that's being hit the most. And that, again, that figures. Now, construction will be linked. Of course, there's more than the housing market to construction, right? You've got big infrastructure and stuff like that. But construction is linked to the housing market. And that seems to be being affected more. Okay. Give me a thumbs up if you think that's interesting as a leading indicator, by the way, to understand what's going on. So I know it's easy just to put headlines, and I vaguely apologize for the headline of the video to get people here to look at it. But when we're here, I want to look at the real data that's underpinning all of this so we can understand as leading indicators what is going on. Do you feel that this is completely disconnected to the housing market, or do you feel it's a leading indicator for the next 12, 18 months of where things potentially could be going? I'd love to hear your thoughts on that. So I'm just trying to keep up with the comments. I know we've got a lot of comments. Yeah, sorry, it's difficult when I'm not on my laptop and I haven't got my glasses on. I will endeavour to go through a comment section in a sec. Okay, right. Oh, there we go. Before we talk about unemployment, so that's the economy. That's the state of the economy. For me, we are not in recession, technically. However, the economy is not particularly doing well. It's flatlined. And I feel it's going to be difficult to go anywhere else but down as now the interest rates are ramping up. Just for sort of a little interlude for you, I've written a white paper. On the state of the UK buy-to-let market. It's specifically for property investors. It talks about why I believe that traditional buy-to-let no longer works, but it looks at the mechanisms, the structures, the strategies that I believe are working now in the current market. I talk a lot about commercial, mixed use, using permitted development, turning it into residential, so making sort of arbitrage on the uplift of the value. Talk about adding value, how to get higher cash flow to avoid the interest rates. If you're at all interested in that, I've got a link there that you can type in and download it totally for free. And I'll put a link in the comments as well after this. It's also in the description of the video. So if you want to get a copy of that white paper for free, it's just a PDF. It will send it over to you. Have a enjoy and read of that. I think it's got some useful stuff in it for property investors. Right. Let's talk about employment then. So, lies, damn lies and stats, isn't it? That's what they say. So this is a graph of the unemployment rate since the 70s. Okay, so you can see we are at historically low points. So when somebody comes on YouTube and goes, whoa, unemployment is on its way up, this might completely melt the property market down, we've got to take it with a pinch of salt. And when I say somebody, I mean me, right? We've got to take it with a pinch of salt because we are at historically low rates. Okay, let's look back at those rates of the sort of, when we had the last major house price correction of 2008, right? Unemployment went much higher in financial crisis. Let's look back again to the sort of 90s, late 80s, early 90s, where unemployment was, huge. Unemployment is low, very low, historically low. And a little tick up from 3.5% to 4% doesn't sound like a lot. If we zoom in, okay, we start to see a trend occurring. And when we talk about leading indicators and lagging indicators, for me, what's important is to understand the trends. So when we're trying to forecast what's on the future, right, if we see a definite trend line, then the chances are that if nothing else changes, right, economic factors, external inputs, if nothing else changes, that trend line is going to continue until something changes it. So when we look at this, it's obvious to see that we're now in a trend up. It's not for a long period, but it's starting. Now, of course, the last bit of unemployment was COVID. It's obvious that unemployment is going to be higher in COVID on this zoomed in sort of thing. But we are definitely started a trend up for a few months now. So that is the sort of overall macro picture in unemployment. But I want to talk about, because I think this is important to understand what is classed as employment and unemployment, okay? So in the figures of employment, obviously anybody in a job, makes sense, is employed. Everybody who is classed as self-employed also goes in as employed, okay? So there could be a lot of people out there who are classed as self-employed who are not actually earning or doing anything right now. So that's another demographic. Anybody who works for more than 1 hour, I think it's a month, is classed as employed. So people on 0 contracts hours, if they work for 1 hour in that month, they are classed as employed. So we're now casting quite a big net over people who might not be actually as economically active or as productive as it seems in those figures. So we need to understand that employment figure being historically low also encompasses a lot of demographics now that wouldn't have been caught in those previous figures from 70s, 80s, all that sort of stuff. And I'll prove that to you in a second. It also, the unemployment figure excludes people who are classed as economically inactive. All right, this took me a little bit of time to get my brain around this. So I just want to, did I put the definition? There we go. Somebody who is economically inactive is somebody who's not sought work in the last 4 weeks and or is not available to start work in the next 2 weeks. So if you've not looked for a job in 4 weeks or you can't start for the next 2 weeks, you also fall out of that unemployment data, which I actually thought was pretty mind-blowing. Because you've now got a huge amount of caveats to this data set of what the unemployment rate actually is in terms of actual numbers of people. If we look at the economically inactive people, it's actually fairly straight line. If anything, it's trending down more recently. But that, by the way, that's about 8 million people in the UK. Right? If you look at the scales, about 8 million in the UK are classed as economically inactive. So that means and by the way, that's of working age as well. So it's not people who are retired. Of course, as the bulge in the age demographic moves into retirement, they all fall out of that as well. So working age, economically inactive, about 8 million people in the UK, which is way more than the unemployment rate of 3.5–4%. Now, here's a graph of the number of self-employed workers, so people who are classed as self-employed. So again, you can see that graph has been trending up actually until COVID. Probably no surprise that when COVID came, a lot of probably tradesmen, people like that, couldn't work, couldn't do their job, so fell out of this. But I want to compare with the unemployment rates of the 70s, the 80s, even to some extent 2008, the last financial crisis, because when we're comparing what's going on with unemployment, it's easy to go, oh look, unemployment is 3.5–4%, whereas in the late 80s, early 90s, it was 12%, 13%. So we're really low, but actually the criteria are totally different. It's like saying right now, oh, base rates of 5%, oh, you got it easy. When I had a mortgage back in the 70s or the 80s, mortgages were 15%. Well, fine, yes, but a big percentage on a small amount is going to be less painful than a smaller percentage on a much larger amount because of the sort of the income ratios of our mortgages and debts. So we have to understand. So a lot more self-employed people in this data set. And this is the graph of people who are classed as 0 contracts hours. Again, you can see the massive spike. That is from 2013, actually, probably when we sort of went, more gig economy, stuff like that. 2013 saw a massive ramp up of people who are on 0 hours contracts. So all of these people now fall into the employed set of data as well. So a lot more self-employed, a lot more 0 hours contracts people. Funny old thing, unemployment looks quite low. especially when the 8 million economically inactive are stripped out of that. I'd love to know your thoughts, team. I'd love to know your thoughts on that data, and if that sort of changes your mind about the unemployment rate, because if we do start to see unemployment go up, if we do enter recession, if we do see everything, tightening, contracting, unemployment goes up, this will affect the property market. Let's just go over it again. Affordability. All the leading indicators for affordability are still, I would say, red. If I had a color chart of leading indicators, with green going, property market's going to explode, red going, it's going to crash. Interest rates still likely going up. Tomorrow's going to be interesting. That's CPI print. More people coming off cheap fixed rate debt. Yeah. Cost of living crisis. So inflation still going up. Core inflation, as of today, could be different tomorrow. Core inflation still going up, making affordability more difficult for people. Getting poorer in real terms with wage growth, even though it's strong wage growth in nominal terms, poorer in real terms. All of these are leading indicators going to put more stress on the market. Markets ticking down. UK HPI market ticks down. More people in negative equity. That's a red leading indicator. Unemployment now ticking up. Doesn't look like a lot, but when you start to strip out all of those things, that's in the red. I've still got a bank of reds in terms of what's going on. So something we need to be aware of. Right, let's see if we've got any comments. I've already gone on longer than I wanted to. Good evening, everybody. Sorry, what I'm going to do, right, just so I can read read the comments, is bring my computer up. So we've got Anthony. How are you doing, Anthony? Due to the pandemic, a lot of companies chop labour costs to be more efficient. New jobs may not occur, but mass redundancy seem unlikely to me. On the look, I don't think we're going to go straight into mass redundancies. I certainly agree with that. I think this whole thing, this is what I've always said, that this is not a black swan event. It's not 2008. It's not going to be a massive boom, down we go. I always believe it's going to be longer. This is going to take longer to play out, but be fairly shallow, because there are the contrary factors. We've got push-pull factors at play. There's always push-pull factors at play. And as they are pushing and pulling each other, right, and one's getting a bit of traction and the other gets a bit of traction, I think it will just be depressing the prices, the property market, for a longer period of time, and then they'll stagnate. I do not think we're going to get 35% nominal term drops. We might do. It is a probability on the quantum. I don't think we'll get there. I think there'll be sufficient push factors to keep it better than that. But the more I see these indicators, the more I feel it might be deeper than I thought maybe 3-4 months ago when we were sort of settling down a bit with interest rates. And we look at US versus UK house price index since 2008. I think there's an interesting correlation. Yeah, you're absolutely right. I did a video also, Anthony, I don't know if you saw it, on the house price. People talk about supply demand. They talk about house prices will always be cushioned because of the lack of supply versus the demand. I don't actually necessarily agree with that as a black and white statement. A lot of it is actually correlated to the ability to borrow. So how much you can borrow, affordability, and how much credit people are giving. That's the biggest factor that plays out the property market. There we go. News today runs story of 25% of small businesses could go bust. Yeah, so I've seen similar things, right? I've seen stories out there saying 700,000 small businesses could go bust in the next year. Before I talk about headlines like that, and this is the point of this is why I do this show, actually. This live stream once a week is to see those headlines, then try and analyze the actual data beneath it, because journalists have this habit of grabbing something and running with it without really understanding what they're putting out there. And I think for me, I would always want to see, as an example, what is the previous track record? What's the previous trend? How many small businesses close their doors every year anyway, in a good year, right? Small business, so many don't get past year 3. Even less of them get past year 5. So actually, what's the churn before all of this is looked at? And look, it's something I'll go and do. I think that is something I'm happy to go and have a look at, is what's the normal small business failure rate, quantifiable, what's a micro business, what's a small business, what's a medium enterprise, right? And what's the trend in that? What I can tell you categorically is there will be lots of businesses who will be struggling more with interest rate rises, because when they're borrowing money, a lot of business borrowing is going to be on variable rate, especially for things like buying property or even buying businesses, variable rate. So businesses are more quickly affected by interest rate rises than homeowners who are fixed into fixed price mortgages. So they will be more susceptible. Interestingly, and I spoke about this with my private client group earlier on today, I feel the banks are being a lot more helpful right now to people with debt. I bought a property a couple of years ago. I actually bought the business with the property sat in, and because I was buying the business, I couldn't get a normal mortgage. I had to get effectively a commercial lending facility, which was a base rate tracker. Great. When I bought it, base rate was 0.1%. Base rate is now 5%. So the mortgage was up to about, I think it's 4 point something. I can't remember off the top of my head what it was above base rate, but I can tell the actuals because the mortgage went from £1,300 a month, and this month is at £2,200 a month. So it's almost doubled, not quite doubled, in the last sort of 18 months. Now, I've got a rent roll of about £3,600 a month. There's a lot of fat on it, so it's got to go up an awfully long way until you're not making profit on that particular deal. Of course, it erodes the profits. But I spoke to the bank. I actually called them last week and said, look, hey, what are you doing anything to help your clients here? The reason I called them is I've actually got tenants on leases in that particular property, and I timed the lease, the break clause or the rent review on both leases was beginning of 2022. So clearly did a rent review, then they're in for 3 year fixed price just before all the inflation started going up and interest rates started going up. So they got a great deal, they locked in. So I can't rent review until 2025, beginning of 2025. Of course, when you do that, it's going to go up quite a lot. So I spoke to the bank about, is there something that we can do to help cash flow until we get to the next rent review date? And they offered me straight away to fix for 2 years at a lower rate than I'm paying now, which I almost fell off my chair when they did that. And I think that's a sign that the banks are actually working with borrowers to help cushion the impact. Now, again, that is anecdotal. That is me with one lender, which is a niche challenger bank. I have no idea if the big boys are going to do that. I don't know how flexible banks will be, but it felt like there was a willingness by the bank to actually help, which I was surprised about. There we go. Interesting. Okay, right. Let's crack on and go to just wrap up with some other news. By the way, give me a thumbs up if that's interesting, looking at that data. Let me know what your thoughts are. Sorry if I've missed any comments in there. Sorry, Nikhil. Hi, Rob. Do you not feel election will have bigger impact in terms of mortgage interest? Yeah, this is an interesting question. I've said for some time that another reason I don't think we're going to get to 35% nominal price drops in the housing market is the fact we've got an election coming up. And there will be policies from both sides that will be there to appeal to homeowners and the property market. Now, look, my gut feeling is the Tories they're between a rock and a hard place. If I was them right now, I'd just be going, look, we're not going to be able to fix this before we come out of power. Let's just, hand over, let somebody else deal with it, and then we'll see how they do and come back in 5 years, right? That's probably not how politicians think. It's just kind of how I think as a business person. It's like, let somebody else deal with it, and then we'll save the day in 5 years' time. Undoubtedly, there will be policies. We've probably heard in the press rumours of things like bringing Help to Buy back. That'd be a terrible idea, by the way. What they can't do is just bring in sort of mortgage, or I've heard people moot mortgage rate relief, on interest rate relief on personal mortgages. They're not going to be able to bail out mortgage holders. That's completely unfair, right? And that will just trash other versions of demographics. I don't think that's the right thing to do either. I think they will bring out policies that will help the housing market. I don't think they'll let it get that bad, and they'll want that to come pre-election. So I do agree. I think the election and run up next year will have an impact for sure. Christian, what do you think would happen to rents in a falling housing market? Generally, Christian, my experience with this, after having been in property for about 15 years now, is rents are generally pushed up a little bit in a falling housing market. But there's so many macroeconomic factors at play here. The main reason for me that rents are being pushed up and have been pushed up, we're seeing double-digit rental increases in the UK right now. That this is very much a supply and demand issue. And the policies of removing private landlords, or the Tory policy of getting private landlords out of the market has been achieved very successfully, and that of course is reducing the amount of housing stock. Now, some people say that's rubbish. There's people buying for everything that gets sold, somebody else is buying it, or every landlord that sells a property, another landlord is buying it. I don't agree with that. There is a definite net decrease of rental units. And of course, when you build that in with the lack of social housing, and then, PRS, private rental sector, having to take the overspill from the social housing lack of. That is what, a lot of that is pushing rents up. And of course, we've now got inflation embedded in. So that's having an impact for everybody. And then landlords are just putting, inflation's at 10%, so I'm going to put my rents up by 10%. Okay, that's how it gets baked in. This will top out, right? It cannot carry on going up like that. It's possible if we carry on with strong wage growth, it could match it, but there will be a top out point. Now, interestingly, I feel we're starting to see that top out point now. I'm very active and immersed in several local areas which I invest in, and have my eye always on the purchase and the rental market to understand, what yields are in local areas, how that yield curve is changing. I do feel in a lot of the areas I'm operating in, we're now seeing rents. I don't know if it's necessarily come down again, but I'm seeing properties come on, similar sort of properties with a lower rent. Now, one of my areas is Chester, and what I've noticed, so Chester, they're building a huge new build housing estate. I don't know how many houses it is, but on the south side of Chester, hundreds and hundreds and hundreds of them, and a huge amount of them have come onto the rental market over the last 6 months. And I'm trying to work out, is this the fact that the house builders are struggling to sell and therefore they're looking to rent their stock out? Or is it the institutions buying from house builders? Last week I spoke about Lloyd's brokered have a deal, or a subsidiary of Lloyd's have a deal with Barratt Homes where they are buying Barratt Homes new build stock and renting them out. Is it a case, of institutions buying stock from new build developers who want to offload and make their profits, and then sticking loads of stock or flooding an area with all the stock they're buying in the same area, which is then bringing the rents down? And I've seen, because I've been tracking it, these properties have been reduced several times now on the rental market. So can we continue at double-digit rental growth? No, of course we can't. It'll top out at some point. I think we're probably getting there, and then we're going to have to see what happens to the trends. I hope that answers the question. Okay. Jack, how you doing? Fame, great to see you, Fame. Thanks for that. Jack, I'm a chartered building surveyor and I wanted to start my own refurbishment firm as the corporate worker is driving me up the wall. I think I might wait to see what happens. Jack, look, personally, I went into corporate role after spending 12 very happy years in the military flying aeroplanes, and I went into a corporate role for a private defence contractor creating courseware for the new private finance initiative, delivering courses to the RAF. I couldn't cope more than a year with it because of the, as you say, corporate wokery. And something that I'm pretty big on is giving people the ability, the skills, mindset, skill set to build ownership of their own lives, right? To be able to buy, take control, businesses, properties. I would say personally, I've said this a lot, personally, I feel the next 18 to 24 months is the most fantastic accumulation phase we've seen in the last 15 years in the property market. If anybody is looking to get into the property market, with what's going on now, with prices starting to come down, I'm talking macro here, it's different in different areas, but generally the market has changed. It's not going up very, it's not going up, and it's not a seller's market. It's now a buyer's market. We're seeing fantastic opportunities. I completed on a property purchase on Friday that was initially marketed last year at 450 grand. I bought it for 345,000, 105,000 pounds off the initial asking price from last year. Various reasons. I'll do a sort of formal video talking through that particular deal, how it's structured and why we were able to negotiate, but we're seeing more of them. Very specific criteria to look for, by the way. Okay, what I'm going to do very quickly before we finish off here, because I know it's 8:15, is let me just go back to the slide deck. I want to see a little bit of the other news out there. And by the way, if you've got any other questions, keep those questions coming. HSBC, I saw this over the weekend. HSBC downgrades 11 property firms in the face of precarious interest rate regime. This is what the banks think, right? Downgraded 11 companies. I'm not sure which. The article didn't actually. Well, I think it probably did, but I didn't. They're not high street names. Probably sort of big corporates, PLCs, things like that, I'd imagine. So that's interesting how those interest rates are starting to trickle into those sort of big boys. Mortgage. I talked about credit crunch at the start. Sort of threw that one out there. An interesting article about mortgage demand and availability to fall since the Bank of England. I've not done too much looking into this. I wanted to focus this week on the data for the unemployment. This is something I'm going to look at. If we look at the subhead there, Bank of England survey suggested that the availability of home loans would fall until the end of next month and the costs would continue to rise. So look, if it's a temporary fall, what you'll find is in these, I've never seen anything like it, by the way, in terms of the rate of change of mortgage products, how many mortgage products are pulled with very short notice. I've never seen anything like it. It's been very, very rapid. Effectively, the banks are struggling to price stuff, and because they're probably getting a big influx of people who are now waking up to the fact that we haven't peaked and interest rates aren't going to go down. And so they get a lot of applications go in. And what a bank will do is they'll effectively, if they get more applications than they can deal with, they're going to price themselves out the market, right? By either pulling products or putting the interest rates up very quickly or putting sort of massive arrangement fees on, price themselves out of the market. So I'd imagine that's what's going on at the moment, is, banks going, well, it'd be interesting to see the number of mortgage applications. I saw when I looked at the stats last week, if anybody follows Christopher Watkin, shout out his channel, fantastic market stats from the estate agency portals. He gets all the data week by week of what's going on. Interesting to see that the amount of mortgage applications has gone up quite a lot. If you remember, sort of this winter, it just dropped off a cliff after that mini budget, went down to levels lower than 2008 or sort of similar to 2008. We've had quite a big uptick of mortgage applications over the last month. And I'm trying to understand why that is. And I feel it is people going, oh, actually, I can't just sit here on a standard variable anymore. They're not going to drop. I need to go and get a mortgage now, right? Or they're thinking about trying to move now before prices drop. It's almost a bit of a surge of activity. Is it people waking up to the fact that we're not going to reverse and go back up, or the interest rates are not suddenly going to reverse and drop back down anytime quickly, that this is going to be here for a while now? So let's get locked in now rather than in a years down the line where base rate might be 6.5, people are even mooting 7%. It's another 2% from here. I suspect, I feel that's what's going on. Love to know what your thoughts are. And then finally, let's talk about the Rightmove HPI, House Price Index, which came out last week. I have to be honest, I don't hold an awful lot of credence to the Rightmove House Price Index. The main reason being it is calculated on the new listing price of properties that hit Rightmove. So it completely disregards all the stuff that's already been on there that might have had massive price drops. And listing price very often bears no correlation to the actual sale price. So in terms of the house price indices, yes, it's the quickest to put data out, and alongside UK ONS is also the most comprehensive. I think the data is a load of garbage, to be honest. We can gauge some stuff from it, but the last few months have seen the Rightmove HPI go up, and people go, "Oh, what's going on? Property market's going up, but UK ONS says it's going down, and everyone's talking about interest rates." Right? Rightmove index going up can just mean that people are putting more expensive houses on the market, because it's not a regressive. All the other indices use something called a hedonic regression model, which is very complex. I'm not going to go into it. Fairly boring. Rightmove does not do that. It basically uses some form of average of things that hit that are listed. So house prices go up on Rightmove. Generally, it probably means that people are putting more expensive houses onto the market, because in the affordability crunch, right? People cannot afford their massive mortgages they took out 2 years ago, 3 years ago. They're coming to the end. They're like, I can't afford. I've overstretched. Can't afford. Let's sell this big house. We need to downsize, and that will push the Rightmove HPI up. That's broad brush. That could be unfair on Rightmove. It doesn't necessarily mean that. It could genuinely be that house prices are going up, right? But we need to see more of that data, and Rightmove don't really put a lot of that data out. So let's see what Rightmove said. So the headline, right, and it's actually quite downbeat, but then with a caveat. The headline is So I've got a weak R. Rate rises quash spring price bounce, but activity holds up. So they're saying that, look, we always get the spring bounce. It's the most buoyant time of year for the property market is spring. So we've seen average new seller asking prices fall 82 quid. I mean, kind of, who cares? But it's the first monthly drop in asking prices this year. And interestingly, the first drop seen in the month of June since 2017. And we need to compare it to different years. So basically it's saying compare it to other years, it's weak. That's what they're saying. The delayed spring bounce in May has quickly turned into an earlier than usual summer price slowdown. Reading between the lines there, right? they're saying that what we're seeing is atypical. The trend is not the usual trend. And that, again, for me, is a bit of a leading indicator, right? But they try and then justify it. Despite some significant increase in mortgage interest rates over the last few weeks, Rightmove statistics currently show no effect on buyer demand, but a slight impact on sales activity. Interesting, again, buyer demand up 6% higher than the same period in 2019's more normal market. I just wonder if people are trying to buy or move now before things get, I don't know, is the answer. Or maybe people are starting to think it's time to take advantage of the market. Who knows? There is definitely, what they are saying is disorderly mortgage markets creating uncertainty, and that's absolutely true. So interest rate rises, look, what we've had over the last couple of months is not going to be felt for a while, 6 months, 12 months. So I don't have too much credence on Rightmove. There we go, team. That's my data update for today. I set myself a task of trying to do this in under 30 minutes. We're already at 51 minutes. I apologise about that. The reason I didn't want to go too long is because tomorrow we have CPI print and UK HPI. So I wanted to maybe squeeze in a second live this week and talk about the CPI print when it comes in. I want to be able to look through the data, crunch it, see where we are, and then probably go live Thursday or Friday. Might be next week now. Let's see what other comments we've got. Paul, hello, Paul. How are you doing? It is going to take recession and how many unemployed to bring down house prices. Is it going to take recession and how many unemployed to bring down house prices? The honest answer is I'm not going to. I don't want to give absolute figures. I said at the beginning of this, anybody who gives you an absolute figure. I saw somebody on a YouTube channel go, I think we're going to be 6.5% down by December. Just why? Why would you come up with a figure like that? Because nobody knows. All we can do is look at trends and then look at the probability of different trends occurring. I believe house prices are coming down, right? I believe we're in a downtrend already. I don't know if you can see this. This is slightly out of date. Let me just hold this up to you. Right, I did this on a live the other day. If you can see that, the green line is 2008. The red line is now. This is a month old now. And what I did, okay, is I put the UK HPI, ONS HPI on my computer screen, and like a real sort of scientist, I traced it. I traced both of them on the same scale next to each other. And if you look at it, right, just look at the top there, red and green coincide and are almost exactly the same. So as of last month, the correction now is almost exactly the same as it was when we started going down in 2008. Now, sorry, let's just go back to that so you can see that again, because let's just see what then happened. What's interesting there is that we went up a lot quicker. The red line went up a lot quicker than the sort of early noughties boom. You can see that the green line, we had a little pause before it then really capitulated. And you can see in the red line, we're having a little pause as well. I suspect the pause will be longer, maybe even a little slight uptick. And if there is a capitulation, it will come after that pause or uptick. Why do I think that? It's not 2008. 2008 happened because there was a credit crunch. Everybody stopped lending, and therefore it was a much more rapid drop, which I don't think we are going to see now. But I just thought it was interesting to compare the two. And then, is it going to take a recession for house prices to go down? Look, here's my view. I said at the beginning, Bank of England and the government, right, they're trying to fix inflation. The only tool they have to fix inflation is basically to break the system, to get rid of it. It's almost like, let's break it. Then the inflation goes, then we can start building up again. That's what they want, a short, sharp break, almost like a fire break. Yeah, short, sharp fire break, get rid of inflation and then rebuild. And in the face of, the models are not working clearly, and hopefully they're revising their models now with all the external impact and, cost of utilities and wars and all that sort of stuff. As wage growth continues to be strong, right, and if the labour market remains tight, interest rates are going to have to go up higher to break it. The higher interest rates go, the more likely there's going to be a catastrophic drop in property prices. Caveat, do not think that will happen necessarily, but it could do. It's on the quantum. I believe we're now starting to see a softening. Right, we're starting to see some of these rate rises take effect, and personally, I want it to soften because I feel the more it goes up, the more it will break and make a mess of everything. If that makes sense. By the way, I don't want prices to come down, but if they are coming down, there is opportunity. Opportunity for me is mainly with selling landlords and commercial property rather than homeowners. Talked about this last week. Not a fan of trying to take advantage of homeowners in debt and swipe their houses cheap. That's not my vibe at all. Very much bigger properties, institutional sellers, professional sellers, that's where the deals are from my point of view. Sean, how much do you think house prices will drop on average from their peak in 2022 to the trough at the end of the falls in 20XX? When do you think the trough will be? I'm not going to give, as I said, I'm not going to give a figure. When do I think the trough will be? I will give, I've always said this, so I will stick to this. I felt the max pain for the housing market will be winter 23 to 24. So we're starting, we're halfway through the summer already. I think I said last summer, so summer 22, I said I think max pain will be winter 23 to 24. And that's why I sold my personal house. I was umming and ahhing. Somebody put a comment on a video when I said the other day that I'd sold my house, went into cash last summer. I actually completed on it in January. Someone said, "Oh, that's crazy, speculating with all your money." It's not speculating. I'd already moved out of the house. And it was a case of, do I rent it, hold it long term and rent it, and me live in rental accommodation, or do I sell it and invest the money? And originally I was going to keep it and rent it. And then I decided, for various reasons, I'll explain another time, to sell it, take the money, mainly because I thought we're going to see this market correction. I wanted to be ready with cash to invest for the next cycle up. Always said I believe the max pain will be winter 23-24, mainly because it's the second winter with high utilities. And I'm not going to go over it now, but if you look back in previous lives, I look at the forward buying costs of wholesale gas, and how when you look at the energy cap that's forecast for the next couple of quarters, it's not dropping. And the government incentive schemes, I can't remember what the name of it is, the £400 we got last year, will not be had. So the price cap's fallen by £500, but you've lost £400 of government incentives. So on average, it's about the same as last winter. So it's the second winter of high utility costs for people. Plus, the gap is growing. The gap is a graph I put up with the amount of people coming off fixed rate. Sorry, if you go down here, the amount of people coming off fixed rate debt. So the amount of people left on fixed rate debt, is that going down? And then the actual interest rate going up. And it's creating this gap that every week is getting bigger right now. More people coming off, interest rates still going up, right? And it's going to carry on getting bigger probably until this winter. Now, into 2024, we're flush. We've still got quite a lot of people coming off 2% and lower debt, by the way, but it's a lot less than this year. And we'll probably be peaking, I would imagine, latest. I say that, this is not a prediction. I would hope it's no later than the end of this year. We could peak, right? Inflation might come out tomorrow and it's halved. Who knows? Unlikely. But I suspect the trough. But then, right, we have a lag factor with all of this. So I think 2024 will be the trough somewhere, and then my gut feeling is property prices will stagnate for a while. I don't know if you, I did a video on, I can't remember which one it was, but I looked at this absolute BS claim that the gurus come out with, which is that property prices double every 10 years. And even now, right, I saw a video from a guru that said, don't worry about short-term fluctuations, right? Buy now, because in 10 years' time, it will double, because property doubles every 10 years, right? Absolute rubbish. If you go and look at the stats, right, and actually look at what's happened, there's a collapsing which way? Basically, if anybody tracks like stock graphs and stuff like that, you'll see it's a compression in the cycles of the property market. And it's compressing. And if you look from sort of 95 or 2000 to now, we're way off doubling every 10 years in terms of being lower, because the highs are getting lower, the troughs are getting lower, so it's all compressing. Now, maybe it might break out at some point on a macro level. Who knows? But when you start looking at money supply and inflation, all these things, like I'm not an economist, I'm just a dude who used to fly airplanes and now buys properties. I do not believe that we're going to carry on seeing that rate of growth over the next 5, 10, 15, 20 years, basically in my professional lifetime. I don't think we'll see the market having that sort of growth of doubling every 10 years. I think there'll be highly localized areas where you'll get it, of course, right? Where there's infrastructure upgrades and things like that. But this is why momentum investing is so important. It's why I teach my clients momentum investing. It doesn't matter what the market's doing. If you can buy something and add value, right, add 25% value or more and pull your funds out, it doesn't matter what the market's doing as long as you don't breach your covenants of lending. It's totally irrelevant. So all that's happening now as a professional property investor is there's more opportunity to buy these deals where we can add value because there's more motivated sales out there already. All right, I'll run through next week the one that I completed on last Friday, which, by the way, took 6 months from starting negotiation to complete. These are not quick things. I don't know if that answers the question. Team, we've probably Got through. Oh, blimey. There's quite a lot of people on this evening. Welcome, everybody. I hope that was useful. Give me a quick thumbs up. If you're new to the channel, by the way, and you found any of that vaguely useful, please give me a like, give me a subscribe. I'm on a mission to help people basically empower themselves to take ownership of their own lives through data-driven and realistic investment in mechanisms that we can actually take control of our lives. Property and business are my two favorite mechanisms, but my aim is to do it in a way that there's no BS, right? It's none of these, come and get into property and you'll be making 10 grand a month within the next 90 days, right? It doesn't work. However, if we do things properly, they are fantastic mechanisms to grow your wealth. So if that is of interest to you, please feel free to subscribe to the channel and carry on getting this data. If we've got no more questions, I will end it for the evening. Sean, no worries. I hope that was useful for you, Sean. It's been an absolute pleasure. Let's keep our eyes peeled on tomorrow's CPI print and HPI. I'm making no predictions about CPI other than prediction. I think core will not drop. And I reckon the UK HPI will uptick a little bit. Let's see how we are tomorrow. Feel free to come on the comments tomorrow if that's totally wrong. If we've dropped loads in core inflation and the UK HPI is now crashing, feel free to say you don't know what you're talking about, Rob. And that'll all be fun. All right, team. I'm going to bid you adieu and I'll see you next week.